Something just shifted in the global energy system. There was no announcement, no press briefing, no emergency statement from Washington. But overnight, oil flows changed. And when energy moves without explanation, it is never random. What you are about to hear was not meant to be highlighted publicly, because by the time it reaches official headlines, the outcome is already set. For weeks, analysts were not watching speeches or sanctions. They were watching shipping routes, because tankers tell the truth long before governments do. And those routes are now telling a very different story. Multiple indicators show that Venezuelan oil is no longer moving through its usual channels. Cargoes that once flowed toward the traditional dollar-based system are quietly being redirected, not through an embargo, not through a public ban, but through something far more effective: execution without noise. According to market tracking data and industry signals, Venezuela has begun shifting significant volumes of crude oil away from the dollar framework entirely. New contracts, new settlement methods, new destinations, all implemented without confrontation. This is not a warning. It is not a threat. It is a decision already in motion. The United States has experienced energy shocks before. Those events were loud. They were reactive. They unfolded in public. This one is different. There has been no immediate response, no escalation, no visible countermeasure. And that silence matters, because when Washington does not respond quickly, it usually means leverage is already limited. Energy does not wait for negotiations. Markets adjust first. Governments explain later. So the real issue is not whether Venezuela redirected its oil. The real issue is why this happened now, and why it happened without resistance. Because timing like this only occurs when multiple vulnerabilities align at once. In the next part, we need to look at that timing, because this move did not happen in isolation. It happened at the most sensitive moment possible. Timing is everything in geopolitics, and this move did not happen by accident. It happened while U.S. strategic petroleum reserves remain near historic lows. It happened as energy markets are already fragile. And it happened during a moment when Washington is politically constrained, economically exposed, and diplomatically cautious. This is why the redirection matters now. Over the past year, the United States has relied heavily on managing perception rather than supply. Officials speak of stability, markets speak of tension, and behind the scenes, energy buyers are securing barrels wherever they can. Venezuela understands this imbalance. For Caracas, oil is not just a commodity, it is leverage. And leverage is most effective when it is applied quietly, not announced. Instead of confronting sanctions directly, Venezuela adjusted routes, adjusted contracts, adjusted payment structures. No declaration was necessary. Tankers that once moved toward dollar-based intermediaries are now appearing on eastern routes. Cargoes are being settled through non-Western financial channels. And once those systems are in place, reversing them becomes extremely difficult. This is not a temporary detour. It is infrastructure. At the same time, the global energy environment has shifted. Refineries in Asia are operating at high utilization. Long-term supply security is now prioritized over spot market prices, and countries with cash, reserves, and political patience are locking in future deliveries. China, in particular, has been preparing for this type of moment. For years, it has diversified suppliers, expanded storage capacity, and reduced exposure to Western financial pressure. When opportunities appear, it moves quickly, not loudly, but decisively. Venezuela fits perfectly into that strategy. For China, Venezuelan oil is not just fuel, it is insulation. Insulation from sanctions, from shipping disruptions, from political interference. And that is why these deals do not require headlines. From Washington's perspective, the problem is not just the oil itself, it is the precedent. Because once energy flows bypass the dollar system without consequences, others take note. Producers begin to question old dependencies. Buyers begin to test alternatives. and suddenly a system that relied on habit starts to fracture. This is why the lack of immediate response matters so much. Sanctions have already been stretched to their limits. Diplomatic pressure has diminishing returns, and military options are neither realistic nor proportional in an energy dispute. So silence becomes the default, but silence does not mean inaction elsewhere. While public attention remains fixed on headlines and speeches, the real shifts are happening at sea in contracts and in payment ledgers. And those shifts are far harder to reverse than any announcement. In the next part, we need to look at the role China plays in all of this, because Venezuela did not make this move alone. And once China enters the equation, the balance of power changes significantly. To understand why this moment matters so much, we need to look at what the United States is facing right now behind the scenes. U.S. strategic petroleum reserves are still operating under pressure. Replenishment has been slow. Purchases have been delayed by price volatility and political hesitation. And every barrel matters more than officials are willing to admit publicly. At the same time, energy markets are no longer forgiving. Supply chains remain fragile. Shipping costs fluctuate rapidly, and even small disruptions create outsized reactions in pricing and sentiment. This creates a narrow margin for error. Under normal conditions, a redirection of oil from Venezuela might be manageable. But these are not normal conditions. Energy demand remains high. Global inventories are unevenly distributed, and competition for reliable supply has intensified quietly across Asia and the Middle East. That is where timing becomes critical. Venezuela did not act during a surplus. It did not act during a period of calm. It acted when flexibility was already limited, and that is what turns a logistical adjustment into a strategic event. From Washington's perspective, options are constrained. Sanctions have already been applied extensively. Diplomatic channels are strained, and reintroducing pressure risks pushing Venezuela even further away from Western systems. So responses must be measured, and measured responses take time. Meanwhile, markets move immediately. Refiners adjust sourcing. Traders hedge exposure. Shipping routes recalibrate. And once those adjustments settle in, reversing them becomes costly. This is where perception diverges from reality. Publicly, energy appears stable. Gas stations remain supplied. Prices fluctuate, but not dramatically. Privately, procurement teams are recalculating risk. Defense planners are reassessing fuel security. And financial institutions are watching currency exposure very closely. Because oil is never just oil, it is transportation, it is manufacturing, it is military readiness, it is economic confidence. And when a supplier begins operating outside established financial channels, the impact spreads far beyond the energy sector. This is why silence continues to dominate the response. Acknowledging the shift would require explaining its implications. Explaining those implications would raise uncomfortable questions. And those questions would expose vulnerabilities that few are ready to discuss openly. So instead, attention remains focused elsewhere. But energy systems do not wait for narratives to catch up. They adapt quietly. And every quiet adaptation reduces the ability to return to the previous structure. In the next part, we need to examine the role China plays in this transition. Because Venezuela did not redirect its oil into a vacuum. It redirected it toward a system that has been preparing for this moment for years. China's involvement changes the scale of this entire situation. This is not a short-term purchase. It is not a one-off transaction, and it is not driven by price alone. China plans energy security years in advance. It builds storage before shortages appear. It signs contracts before crises become visible. And it avoids public confrontation whenever possible. What is happening with Venezuelan oil fits that pattern precisely. For China, securing supply is not about headlines. It is about insulation. Insulation from sanctions, from shipping choke points. From financial pressure exerted through Western institutions, Venezuela offers something increasingly rare: large reserves, flexible terms, and a willingness to operate outside traditional systems. That combination is extremely attractive in the current global environment. Over the past decade, China has expanded its ability to settle trade using alternative currencies and clearing mechanisms. These systems were not built overnight. They were designed quietly, tested gradually, and activated selectively. Energy trade is where those systems matter most. Oil transactions involve scale, repetition, and long-term commitments. Once they move outside the dollar framework, they create momentum. And momentum is difficult to stop. For Venezuela, aligning with China reduces vulnerability. It lowers exposure to sanctions enforcement. It stabilizes revenue flows, and it provides political cover against external pressure. For China, it secures supply while weakening a system it views as a strategic risk. Neither side needs to announce this publicly. The structure speaks for itself. This is why Western responses appear restrained. Applying pressure on Venezuela now risks accelerating the shift rather than reversing it. Challenging China directly introduces a much broader confrontation, and attempting to isolate both simultaneously would strain alliances and markets. So caution prevails, but caution has consequences. Every successful transaction completed outside the traditional system validates the alternative. Every contract honored reinforces confidence, and every month that passes normalizes the new route. This is how transitions actually happen, not through sudden collapse, but through gradual realignment. By the time the shift becomes undeniable, the leverage is already gone, and that is the real concern unfolding beneath the surface. Because this is not just about one country or one supplier. It is about whether energy trade can move at scale without relying on Western financial control. If that question is answered in practice, not theory, the implications extend far beyond Venezuela. In the next part, we need to look at what this means for the United States directly, not in abstract terms, but in real-world consequences that begin quietly and compound over time. The consequences for the United States begin quietly, not dramatically. There is no immediate shortage, no sudden spike that forces emergency measures overnight. What appears instead is friction. Refineries begin adjusting blends. Procurement teams hedge more aggressively. Transportation costs edge higher in ways that are difficult to explain publicly. These are not headlines. They are early signals. Energy systems rely on predictability. When suppliers become less predictable, every downstream decision becomes more expensive. This is especially critical for sectors that cannot easily substitute fuel sources. Heavy industry, aviation, defense logistics, military readiness in particular, depends on secure and flexible fuel access. It is not about current stockpiles alone. It is about guaranteed replenishment under stress, and that guarantee becomes weaker when suppliers operate outside familiar financial and political frameworks. This is why internal assessments matter more than public statements. Behind closed doors, planners model scenarios that never reach press briefings. What happens if supply tightens during a crisis? What happens if multiple suppliers realign simultaneously? What happens if energy trade becomes fragmented along geopolitical lines? These scenarios do not assume catastrophe. They assume complexity, and complexity is costly. At the same time, financial markets are adjusting expectations. Currency exposure increases. Hedging activity intensifies. Risk premiums creep into contracts that once assumed stability. Again, this is not panic. It is recalibration. But recalibration across multiple systems compounds. Each adjustment feeds into the next. Energy costs influence inflation. Inflation influences interest rates. Interest rates influence growth and political tolerance. This is how a silent energy shift becomes a macroeconomic issue. Public messaging remains calm because volatility itself can create problems. Acknowledging fragility invites speculation. Speculation accelerates movements that policymakers want to slow. So restraint dominates the narrative. But restraint does not stop the underlying process. As more transactions settle outside traditional channels, confidence in alternatives grows. Producers observe that payments clear. Buyers observe that deliveries arrive, and intermediaries adapt accordingly. This is how systems evolve, not because the old system fails all at once, but because the new one proves functional under pressure. And once functionality is demonstrated, usage expands naturally. The risk is not that the dollar disappears from energy trade overnight. The risk is that it becomes optional in places where it was once mandatory. Optional systems lose leverage. That leverage is what allowed enforcement, coordination, and crisis management for decades. When it weakens, responses become slower and less unified. This does not lead to immediate collapse. It leads to fragmentation. Different regions operate under different rules. Different currencies settle similar trades. Different alliances prioritize different forms of security. Energy sits at the center of that fragmentation. Because energy touches everything, as this process continues, official acknowledgement will eventually arrive. Statements will be made, policies will be adjusted, explanations will follow. But those explanations will describe a reality that is already in place. This is why the present moment matters, not because it looks dramatic, but because it represents a point of no easy reversal. The shift did not require confrontation. It did not require escalation. It required patience, preparation, and timing. And once those elements align, systems move quietly. The question now is not whether this trend continues. It is how quickly it spreads. Because if energy can move reliably outside established frameworks, other strategic resources will follow. And by the time that pattern is widely recognized, it will no longer be a warning. It will be the new baseline. That is what makes this moment worth paying attention to.